from head to toe, how do we go and do some day trades with a strategy that's very, very consistent, has a very high hit rate, allows us to get very, very good deals in the market, meaning that our risk to reward is extremely good. We risk a fraction of what we tends to get, and the probability of that happening is very, very high. So the quality of a strategy, the first thing is, whenever there's a strategy, what is it based off of, right? And what it should be based off of is core market principle, the main fundamental principles, right? Because if you start getting more complicated than the basic principles, you will overcomplicate it. And this is when somebody is building a strategy, and this is just, I'm just ripping the band-aid off. If you see like a really, really good performance, like an extremely good performance from backtest, chances are 90% or 95% that you're overfitting. So all you did was, change the settings and made sure that the settings were perfect for that time frame, or like that specific set of data that you're trading it on. But if you then move to a different coin or a different time frame, or really just a different time in the market, it's not going to work as well. And that's not a strategy, right? A strategy is something that we can rely on consistently, and that is something, like this is essentially the end result from what I have seen until now, because it's the most consistent strategies that I have seen until now. So yeah, here we go. So when we trade our strategies, what is the stock strategy? At this point, most of you guys know it's a trend reversal strategy, right? So core market principle, we have ranges, and then we have movements between those ranges, right? Very quickly, just super quick recap, because I've done this many times. Range, movement between a range, another range, movement between a range, another range, movement between a range. So when we're trading in a range, then we're expecting the price to bounce within the range, right? And we're going to be right more often than not, which by default gives us a high hit rate. Then we have a trend following strategy, which is something that the ETH Turtle is doing, which is, it will long somewhere here, and then it's just going to wait for this move. This move, however, on a 5-minute time frame takes, 2 days or something like that, depending on where we entered. If we look at a higher time frame, at a 4-hour time frame, then we can wait for, multiple days or even weeks in order to get our move, which is fine, and that is something that we do in these time frames. But when we're day trading, we're looking at completely different times. So, but it's still something important to note. So when we're in a range, we're trading bounces off the range, right? I can make it a little bit prettier here. We're trading bounces off the range. So that's our default. So by default, we're setting ourselves up pretty well. Okay, how can we make this better? How can we make, our hit rate, or how can we be right more often? Well, we'll look at confirmations. We have gone through many indicators and many things, and a lot of them work. But really, when it clicked for us was when we look at different confirmations, specifically from multiple time frames. Because what this gives you is, when we look at the stochastic, right? We're looking at the stochastic at the 5-minute, right? That's an oscillator, meaning that it's telling us, in a very subjective manner, how far we are from the average. Are we too low from the average or too high from the average? And 50 is essentially the average, right? So, and this, if we trade only one stochastic, especially when you go to lower time frames, if you would trade only that, then it would not work really well, because there's a lot of false signals. Let me give you an example. This is a great example right here. the stochastic topped out, right? So we would be shorting here, but we wouldn't because the price goes much, much higher. So, and that's just because, we have a stochastic, and the stochastic's actually doing its job. It's telling us at this point, when we topped out for the first time, we got close to the top of the range, which is exactly true, which is exactly what a stochastic is supposed to do. However, the thing is that we're not, the market is not a 5-minute time frame. The market is all time frames, and all of them are just different perspectives on the same thing. So when we go to this time, let me just, let me just put a vertical line here, and let me go to a 1 hour and try and find that vertical line. Well, okay, so our 1 hour was topped out too, right? Our 2 hour, 3 hour, 4 hour, here we can see that the 4 hour was just about topping out here. When we go to higher time frames, the 8 hour was just going up, right? And 12 hour was just going up. So you might see a pattern here already. When looking at smaller time frames, they might give you small indications of where the price is going to go. However, the higher time frames will tell you, obviously, on the higher time frames. The trick happens that when you put them all together and you get an overall bias on the market, and then you trade when you have an alignment over those different time frames. Because when you do that, you don't have to be right about the market all the time. You just need to wait for the time where the probability that you're going to be right is the highest, and that is when you trade. And if that means that, there's 3 days in a row where you don't trade, then you don't trade, right? And when you trade the stock strategy, there's days where it's much, much easier to find trades, and there's days where it's much harder to find trades. And the reason for that is the alignment of the market. When the market is more volatile or more choppy, then it's going to be very hard for the lower time frames to align with the higher time frames. Which, by the way, it might seem, like not a good thing that we don't find trades, but that's actually exactly what we want, because it, by default, right, it filters out the times in the market where we would enter and where we would actually trade lower probability trades. And just because of our rule set, the alignments just don't happen, so we don't end up in a situation that might be bad for us. And that happens by default trading the strategy, which is very good. And I'll try to explain this a little bit more now, because by modeling a strategy around core market principles and around how the market works, then without you having to do any extra work, you will automatically get a lot of benefits. For example, here, we're trading ranges with confirmations, meaning that by default, our hit rate, our win rate is very, very high. We don't have to do anything extra, it's just very high by default. Also, when the market is not choppy, when the market is choppy and when there is not, clear direction where the market's going to go, we don't get any signals by default, right? So the strategy itself takes away the extra toll on us, where we would have to say, okay, I don't want to, I'm not going to trade today, which is something that's very, very hard to do. But if we follow a specific strategy, and that strategy just doesn't show any trade for the day, then that's what it is, right? And that goes back to consistency. What are the 3 pillars of consistency? We have strategy, we have mindset, and we have risk management, right? The mindset is, okay, I'm just going to stick to the strategy, I'm not going to do anything else. The strategy part is, that's actually a strategy that has been proven, many times over on many time frames, many coins, many markets, over and over again, to make sure that it is viable, and also logically needs to make sense, right? And that's something that we're trading. So what do we do? Well, number one thing that I do is I look at Bitcoin when I'm trading crypto, of course, because Bitcoin moves everything else, obviously. So the first thing I do is I look at Bitcoin. I start with the middle time frames, and then I look at the higher time frames, and I look at the lower time frames. And we'll do that right now. Right now, I can already see we're in a range, right? 15 minutes topped out here at the top of the range here, so this would have been a pretty nice short, most likely. When you're here, I haven't looked at other time frames, but I assume that the lower time frames topped out here as well. Yeah, they did. And I assume the higher time frames, okay, the higher time frames were topped out already and then turn around. Same with the 1 hour starting to go down. So this might actually be a bigger move too. So, and we're going to go over that, but by default, we're at the top of the range. We're topping out stochastics. That's a good start. Right, so okay, I started looking at the 15, 30, and 1 hour for my daily trades, and I started looking at Bitcoin. And then once we analyze Bitcoin, we see, okay, and this is not what is the bias up or down. That's not what we're doing. We're looking at every time frame, and we're trying to connect the dots to get a flow from lower time frame to higher time frame. And as we do that, then we'll see, okay, if the time frames, for example, the higher time frames were very, very bullish, but the lower time frames are very, very bearish. What would that mean? Well, that would mean that we'd probably have, a smaller move down before we move further up. This would make sense, because if we want a big move up, what does usually happen? Usually there's a liquidity grab, for market makers or for larger institutions to enter the market. So we need to push the price down and fill the liquidity. And, that happens pretty often. Obviously, because that's how, it's core market principle. If a market maker is trying to enter a trade and, they need to enter with $100 million or something like that, obviously you just can't market buy, right? But what you can do is you can have an established range, and you can wait until there's a lot of liquidity above and below with stop losses, and then you can push into that liquidity, trigger the stop losses, take over that liquidity, and then you can move. And how that looks like specifically in the market is that usually whenever you have a big move, for example, here we had a volatile move down. What happened before that? We went way above this range. So we took out all the stop losses that we could have in order to make this move down. And this happens very, very, very often. So we need to be aware of that, obviously. So, let's start about the overall market that we see right now. So we see the 15-minute is topped out. 5-minute has been topped out, is going down now. 3-minute is going up. Okay, so those are lower time frames. Our 1 hour has been topped out for a long time. What does this mean? This means that we topped out at the top of the range. Makes sense, right? But then as we started going further up, the stochastic has nowhere else to go, so it's just stuck up. And at this point, it's pretty much invalid because you don't know how much higher it goes, right? So trying to short these moves does not make sense. However, when the stochastic starts going down and gets a lower low than our other tops, then it starts to become viable again. And that is something that's happening currently on the 1 hour, which is interesting, with the 30-minute kind of in the middle here. And as we know, what happens in the lower time frames will affect what the higher time frames do. So if our 30-minute would top out and start going down, and then our 1 hour would obviously go further down. And if our 1 hour goes further down, we look at the 2 hour that's topped out, starting to go down. So that one will go further down, right? So really, what it is think about them as like metal balls, right? So, and this is just a line in the sand of a metal ball. And by default, it's jumping up and down and up and down, right? And then obviously there's other things that are happening. So that's the default, right? So the higher we go in the time frames, the heavier the ball. So the more pressure, or the more strength and power it takes to move it, right? How is it being moved? By the market, by the price, but also by the lower balls. So the 1 hour, okay, so the 1 hour here is, has been topped out and is trending to go down, right? The 30-minute is, somewhere in the middle here and trying to turn down as well, right? So as that's happening, the 1 hour is going down as well. The 2 hour is topped out here, going down, and the 1 hour is going down as well. So we can assume that the 1 hour will keep going down because the 30-minute is not interfering with it, right? It's actually helping it. So we can assume that the 1 hour will keep going down. So now from a smaller move, we assumed, or we could project that into a larger move and see that this is likely to go further down. And as the 1 hour is likely to go further down, what that means is that the 2 hour is likely to start turning down, right? Because it's going further down. So by default, the heavy ball, like it would take a lot of energy to stop this ball, right? The only thing that could stop it would be a lower time frame, but the lower time frame is just increasing in speed too. So the 2 hour is likely to just keep going down as well. So that's the 2 hour. What's the 3 hour doing? Okay, so the 3 hour stopped out too, going down. There's like a speed decrease here. However, the 2 hour, we just established that it's likely to keep going down. So the 3 hour should continue going down. What's the 4 hour doing? 4 hour doing the same thing. Was stopped out, is going down. So okay, now we're getting some sort of pattern here. 6 hour topped out, starting to go down. What is this? What's going to affect this number, this line of the 6 hour? The 4 hour. And we just established that the 4 hour is going to go down. Why? Because the 3 hour is going to go down. Why is the 3 hour going to go down? Because the 2 hour is going down. Why is the 2 hour going down? Because the 1 hour is going down, right? And how is the 1 hour affected? By the lower time frames. And we'll get into that later. So the 4 hours stopped out going down 6, 8, 12. And now these ones are, when we look at our day trades, right, between a 15:30 and 1 hour, well, then obviously 12 hour and daily, they're pretty far from us right now. And also, they're very large time frames, so they're very lagging, right? So these are like these huge metal balls. And the entire market can be moving in the opposite direction, but the metal ball is still just slowing down in the first direction, right? Before it starts moving down. So it's very heavy, very slow. And then, if you go into the daily, weekly, and monthly, then, that's a whole different thing. What's also very nice to look at is that the higher time frames, they're actually very easy to trade compared to the lower time frames because they follow the stochastic very well. Because it's just much the reason why lower time frames don't follow the stochastic is because, or like they do follow, but sometimes they don't, or there's false signals, or it's topped out for too long, stuff like that, is because there's many other factors in play that are chopping around with the price. In a perfect world where the price would be in a vacuum, the stochastic would exactly tell you what's happening. But there's buy sells going on, there's liquidity like being pushed in, pushed out. So there's a lot of stuff going on. So you have choppiness. When you go to the monthly, you don't have that choppiness, right? Because it's much harder to influence a monthly chart than it is a hourly chart or a 1 minute chart, right? So this is our current overview of the higher time frames. So now we established, okay, so short wise, that would actually make a lot of sense for us. And as we're talking about it, right, what the market is doing exactly what we're assuming it to do, right? So now that was the 30-minute. Now we start going down. Now this 15-minute in general, right? And I might, just throw a lot of information at you, but don't worry if it's too much. I'm just gonna repeat it like 1,000 times over the next few months. So all good. But in general, And that's a rule of thumb. You can look at it more specifically as well, but rule of thumb is that it takes 2 cycles of the lower time frame to fill the higher time frame. So what that means is that one up and down in a 30-minute, right? Maybe there might be a good example here. One up and down in a 30-minute would be 2 ups and downs in a 15-minute, right? So what that means is that if you scale the 15-minute into the daily, then there's like a million ups and downs, and that's probably not going to be that effective, or like it's so far that with the 15-minute alone, you're not going to really see what the daily is going to do. But if you scale it up as we did across all the different time frames, then you'll actually get there, assuming that they're aligned, which in this case they are. So our 30 minutes going down, and it's above 50 still going down, right? Usually it bottoms out at around 20 to 15, so we still have some ways to go, which is important because the bottom of the range, the price is at the bottom of the range right now, but the stochastic isn't. So the stochastic's telling us that we still have ways to go, but we're at the bottom of the range, which means that very likely, this is an indicator that we can break that range. But this is the 30-minute. We haven't looked further down. Our 15-minute now is topped out going down as well. That's good. That's a good sign if we're bearish. And once again, we're at the bottom of the range in the 15-minute, which is a much, much smaller time frame, right? So it's much more sensitive. But even that one, is topped out going down. And it's not even at the middle yet, which can tell us that, okay, we can have some more downside. Let's see what the lower time frames are doing, like the smallest time frames are doing, right? I don't know, I haven't looked, or it was open, but I don't remember. However, if the 5-minute would be topped out at this point right now, then that would be a very, very bearish sign, because we just reloaded the stochastic on a 5-minute, we would go further down. If the 5 minutes bottomed out, what would that mean would be that, either it just gets stuck on the bottom and we go down, or we'll have one more cycle on that 5-minute, meaning that the 5-minute will bottom out, go up again, top out, and they'll go further down. And in this 15-minute, it will just, stay stagnant and then continue going down. So we'll see what, okay, so it just about bottomed out, right? At the bottom of the range. So now we have 2 options. Our 15 minutes still well underway and very, very strongly down. So the 5-minute right now will decide whether we break the range or not. Because what the 15-minute can do is, if the 5 is just too weak and it bottoms out, and then we start going up, and that move up on the stochastic and the price will move this 15-minute back up, then that's a failed move to the downside. And even though our high time frames are, primed for a short, those are high time frames. So we can have like 30 tries like this, So it's still a long way to go. So our 5-minute is bottomed out. Okay, let's look at the 5-minute more granular. Let's look at the 3-minute. The 3 minutes bottomed out. However, it got kind of stuck here, right? So it tried to go up, couldn't, and went further down. Now we're really at the bottom of the range here, and the 3 minutes bottomed out. Let's see what the 1 minute's doing. 1 minute as well is stuck, right? So we got the 1 minute stuck, we got the 3 minute stuck. Now the question is, does the 5-minute turn down, right? Does the 5-minute turn further down? And if it does, does it get stuck here? And if it gets stuck here, then we can get the 15-minute to turn down, we can get the 30-minute to turn down, we can get the 1 hour to keep going down, and then we have a big move. Many of these strategies that we have here on the dashboard, they're trading on the 4 hour, 6 hour, and 8 hour. So looking at the 4 hour, I do like to look at this quite a bit. And the 4 hour is primed for a short right here, which would make sense at least to this range, back to this range, right? So if this happens, then this would make a really, really good short even on the 4 hour. In fact, this short could have been entered a bit earlier as well. So let's just assume on the 4 hour that we're gonna short that we assume that this is gonna be a short. So let's just go back to our day trades. I don't love the fact that we are. If I was to enter this now, right? If I was looking at this a couple hours earlier, it would be much, much easier to enter because it would just enter the top of the range and we would already be in very, very good profit, right? On a 10x leverage, 20x leverage, day trading leverage would be up 20% with the chance of the 4 hour breaking down, which would give us another 40 or 50% or something like that, right? So that's a huge move. However, we don't have that. And if I wanted to enter this now, then I would not love to enter this at the bottom of the range. Ideally, what you want to do is scale into it at a higher time frame. Usually, the way we would enter, if we would, do the 15-minute topped out, aligned with the 30-minute, aligned with the 5-minute, which is usually how we do it, we'd enter a short here towards the top of the range. But what we would do on top of that as extra would be put our stop loss higher. We're kind of in a range like there's not many levels here that we can trade previously, but we would enter and we would scale more entries higher up. What that would mean is that even if there was a liquidity grab, right, which there wasn't, but even if there was a liquidity grab, we would enter more and we would move our average order higher, which would give us a much, much better entry on this trade by itself, right? Just this range alone. So just trading just this range alone, as we touch the bottom of the range and we're trading this range, even though we might have a larger trade going on here, I would still take some profits because this larger trade can happen now. It can happen 2 days from now. We don't know how long we get stuck in this range. So we're ready for it, but we're still trading our range and we're long and bottoming our range. If I was to trade only on the 4 hour here, then I would just enter. I would get ready to scale in more higher up, and then I would just wait for this move to happen. This range on a 4 hour, it can take like here 4 days, 5 days. And that is something that many people don't realize, is that depending on the chart or the time frame on a chart that you're trading, it's a very, very different time scale. And they get impatient after waiting for 5 hours and the trade didn't happen yet. But you're trading on a 4 hour time frame, which means that the move to happen can literally take a week. So it would be a very, very long week for you if you don't expect that, or you're not aware of it. So we got an overall bias on the market, right? That's the higher time frames. Now on the lower time frames, what's going on? Well, at this point, we just want to see, do we break lower here or what's going to happen? What we're looking for is for ideally the best thing that could happen to us right now with the 4 hours, with the higher time frames being topped out, is for the 5-minute and really 15-minute as well, and 30-minute actually. If they would top out and we would go back to the top of the range with all these time frames topped out at the same time, so really reloaded, then that would be a prime short for us. Right now, we're pretty low because we're in the bouncing area here. If I had to trade this, I would enter with a much lower amount here, and I would have one order here, and then I would have a bunch of orders at the top of the range, right? So what this would mean would be that I might, if this move just happens without me and I entered with like 10-20% of my account, then that's what it is, you know. But it's not a great deal because as of right now, I don't know if the range is gonna break. So with my 10%, my setup, my setup is actually really, really bad. My setup is a 0.19 risk to reward, right? Which is something that we would never trade. This is actually a long. However, that's why, 90% of my position would be up here. And if I would scale into it, well, then my risk to reward would look much better, 5-1, and that's a good deal that we want to trade, right? I like high probability trades, so I would not enter at the bottom of the range just because it's the bottom of the range. Yeah, we can break down lower. Fine, then that's what it is. It does not matter if we miss a trade. There's just going to be another trade, and then there's going to be another trade. We're looking at it at a basket of trades, right? Minimum number of trades that you can look at. Smallest number of trades that you can look at is 20 trades, right? So within my next 20 trades, I know that there's going to be, a move just as good as this, right? So there's absolutely no reason for FOMO. The only reason why you might feel FOMO is because you are thinking too short term. FOMO means, obviously fear of missing out. What are we missing out on? One trade move, like one market move. The market's going to be around next week. So why would you risk an amount, or why would you put yourself in a bad position just to catch a move that will repeat itself over and over and over and over again multiple times a week forever? Why would you want to put yourself in a bad position for that, right? What is a good position? A good position is a good deal, meaning that the money that we put into the market, for that we get the biggest profit potential that we can. Let's assume that we're trading with $100,000 and we, at any point, the maximum that we want to risk is 10%, right? So essentially, we're trading with, we're risking, at any trade, we're risking $10,000, right? So if we're trading this short here, let me just make it a little easier to see. So if we're trading this short here, the red area is our $10,000, right? This is our entry. If we the maximum that we're willing to lose is $10,000, so our stop loss would be $10,000 for simplicity's sake, right? So, and that just makes sense. If we have a trade like this, then this area is still $10,000 because that's the maximum that we're willing to risk, right? So at this point, $10,000 that are in here are giving me this much profit, right? So $10,000 are giving me, well, $7,000 in profit, right? Or actually not even, but for simplicity's sake, right? Our risk to reward is 0.7, right? So our $10,000 are giving us $7,000 of profit. If we just had a better deal and if we scaled in at the top of the range, then our $10,000, right? Same move, same amount of money. We're still risking $10,000. If we entered here, you might think, how can someone enter at the top of the wick? That's not realistic. It is realistic if you scale before this wick even happens. You scale your top of the range. You will fill here, and your average entry is going to be pretty damn close to that top of the wick. So you're at the top of the wick here, right? Now your $10,000 is gonna make you Now your $10,000 is gonna make you $50,000. How? We didn't change anything. The only thing that we changed is how good the deal is for us. It's the same market. It's the same market movement. The only thing that changed was that we have a much smaller area that we need to expose our $10,000 to, which in return gives us, first of all, a smaller area, which means that we have a much bigger area for the profits. And then second of all, the smaller the area is where we put in the $10,000, the more value we get for every dollar in the $10,000. Right? So we get a double multiple on the trade, because number one, our risk to reward ratio is higher, right? So as opposed to a, say, 0.5 risk to reward, meaning that for $10,000 that you risk, the maximum that you can get is $5,000. That's a 0.5 risk to reward. Now we have a 5 risk to reward, which means that for every $10,000, for the $10,000, we get $50,000. And on top of that, we also have a much, much larger area to trade on. So we just improved our risk to reward ratio, but we also improved the area in that we're profitable. And also, if we traded here and we entered, then most of the time would be negative. Here, almost 100% of the time is positive. We're positive. So this is a theoretical risk, right? But when you are at the bottom of the range, and looking to break through, then the chance that you actually risking the $10,000 when you've been in profit for the entire trade for multiple hours is actually much lower than if you would be negative for the entire time. Because you need to think about it this way. If, something happened on my exchange and it would just automatically close my trade right now, would it be profitable or negative? Right? So the way you want to trade, rule of thumb, is that most of the time, if your trade just closed for whatever reason, you would be profitable. If you think about it this way, what that would do would be that that by default you'll be exposed to the upside much more than to the downside. On top of that, you're getting the biggest reward from the amount that you risk, and on top of that, you also have a much smaller area where you're risking and a much larger area where you're profiting. So you are automatically positioning yourself for profit on, I don't know, like 7 dimensions or something like that. And that's literally just because we understand how the market's working and understand the fundamentals and mentality of the market. And because of that, we then know how to position ourselves to make sure that by default there's many more things that are in our favor than against us. And if people don't understand this, what this will mean is that, also by default the way the market's formed means that most of the time they will, without exactly knowing what they're doing, they will be positioned at a disadvantage basically always, right? How does the market work? How do people react? Well, they see a big red candle, so they start shorting. Why do they start shorting? At the bottom of the range. So by default, compare trader 1-to-1, they're doing the same trades. Well, the one with the 0.17 risk to reward ratio compared to the one with the 5x risk to reward ratio, well, the one with the 5x will always win. Over a period of 20 trades, they'll always win. So this is why it's so important to understand the market fundamentals, because you can position yourself right away at such an advantage compared to other people that it's going to be much, much, much harder for them to beat you. And yes, it is a competition because it's a zero-sum game, meaning that there's a certain amount of money in the market, and if someone wins, someone else needs to lose. Right? So that's very, very important. So when we're entering trade, right now, overall, the trade that we're looking at, we're still at the bottom of the range. We're probably going to be dancing around here quite a bit, which is actually good, because what we want is that if the price stays towards the bottom of the range and we reload our stochastic back to the top, then that's a very, very bearish sign, because the price didn't move, but we just reloaded our stochastic. If the stochastic's topped out, where else can it go? There's only one way it can go, which is further down. And if that happens, well, then that's just another great short position. So looking at Bitcoin, what I would do is I would wait for the price to drop. However, that's Bitcoin. That's our step one, right? And we just spent, a lot of time on step one because it's important. However, now we know what the overall market bias is, and we know what the overall market bias is in crypto in general, because Bitcoin, moves the market because it's by far the most influential coin. However, we just found that, we're kind of late for that short. But there's a lot of other coins. So the next step is now we don't have to trade Bitcoin. We analyze Bitcoin, but we can look at other coins and we can see coins where the setup is better for us than it is on Bitcoin right now. So what we can do is we can look at other coins and see maybe some coins are at the top of the range right now, lagging behind Bitcoin with the stochastics topped out, and maybe we can catch this move that we missed on Bitcoin. Maybe we can catch it somewhere else. And also that move by itself, where that's a 1.3% move on Bitcoin, on different coins like Chiliz or Litecoin or XRP on Solana, haven't looked at any of them, but just assuming, the percentage move there would be much, much higher. So we would once again get a much larger value for the work that we have done. So we can look at, say, Chiliz. Okay, Chiliz actually went further than Bitcoin, right? It broke range number one, is at the bottom of the next range. See what Solana is doing. Solana is also breaking further down. So we can see that actually right now Bitcoin seems to be lagging towards other coins, because those, whereas Bitcoin started to bounce around the bottom of the range, all these coins broke down. So we can assume that Bitcoin's going to break down as well. But yeah, all these coins already broke down. So we're not going to catch any coins at the top of the range, most likely. I mean, we can go through a bunch of coins and maybe you guys will find some, but doesn't look like it right now, because it looks like those already broke down. So Bitcoin's actually trailing in this case, not the other way around. But yeah, let's just go back here. So that would assume, this would look like, that Bitcoin's probably gonna follow the altcoins at this point. So it's the other way around, really. So so number one, what we did was we looked at the higher time frames, and we didn't just look at the stochastics. We tried to align the stochastics from bottom to the top, and all of them, because the lower time frames will move the higher time frames, and they will not overrule them, right? But the lower time frames are the ones that give the higher time frames the nudges, right? The right nudge. And the stochastics are essentially, big balls, big metal balls. So once it gets its momentum and its inertia, it's very hard to stop, unless it gets to the bottom or top of the range where it just doesn't have anywhere else to go, so it has to turn around. But until that point, it would take a lot of inertia to stop it and turn it around and have it go the other way. So if we're, if it maybe like undecisive
or we're towards the top of the range and we don't know when we turn back down, well, we can look at the lower time frames, because those are the ones that will nudge the higher time frames and, you know, start the inertia, start the momentum, and then eventually the higher time frames will start going down. So we did that, and we aligned it and connected all the time frames together to get an overall idea, which we just did live, right? And then we looked at, okay, how do we want to enter? We want to make sure that we get good deals, right? And, you know, the best deals that you can get here is by looking at the market, and rather than chasing moves, you look at it this way and be like, okay, well, this might not even be, like, now looking at the altcoins, it actually might still be a good move. However, what would also be a good move is that if our lower time frames would top out again, we would go back to the top of the range, and then we would go further down. And if that happens, I can just put my orders there, and if they hit, then I directly have a great move. So I anticipated the move. It might hit, it might not hit, right? But if it does hit, then I will have a great deal by default, much better than anyone else, or, you know, most traders. And what that does then is that I'm always positioned at the best possible scenario that I can have. So rather than chasing the move, I can anticipate the move and be like, okay, if we go further back up here, and now I analyze the market and I'm waiting for the move to happen, and then if it happens, only if it happens, I enter it, then I will by default have a really good entry, because I didn't react to the market, I anticipated the market, right? Which is something that, you know, if a couple hours ago we would look at it and we would be towards the middle of the range, and, you know, the higher time frames are the same as right now, we would be like, okay, well, if we go to the top of the range, that's a great entry, and we'll have a great move down. And that's exactly what we would do. We would put our orders here, we'd fill those orders at around really this price, average entry, and we would already be in a very good profit before the big move even happened. So anticipating it is very important. And then, you know, analyzing Bitcoin and then looking at other coins and seeing, okay, can I catch a better deal at a different coin where the setup is how I saw it, but, you know, it's just better. There's better alignments. We're still towards the top of the range. The move didn't happen yet, or the move can be bigger. And, you know, by default, altcoins will move more. So whenever you're right, you know, you're right more by default. And yeah, that's essentially from A to Z how we look at a trade, or how we look at the market with the stock strat. We align them, we align the time frames, we connect the dots together, see, okay, how does it look like? Then we anticipate the next trade. We're like, okay, well, if the lower time frames, they top out, they align, well, then we enter. So we're anticipating the trade. So by default, we're not chasing, we're anticipating, right? So we will not FOMO into a trade. We'll wait for the market to come to us. And we can do that on other coins as well, not just Bitcoin. And what will happen there is that we'll find better setups than just Bitcoin. And yeah, that's essentially how I look at the market when I trade the stock strategy. And, you know, how we explain, by default, there's so many things going in our favor without us even doing anything. It's just because it's very well aligned with the core market fundamentals. Okay, let me read this. I think most people enter at the wrong end of the range, correct? Should you always be trading out of a range then? Just make sure you enter on the right side of the range. You don't have to trade out of the range. Actually, like the stock strategy is actually trend reversal strategy, meaning that you're trading within the range, right? But when you're at the top of the range or at the bottom of the range, what this does is that when you're towards the top and the bottom of the range and you have all your confirmations, then you're much more likely to bounce off the range. But because you're trading ranges, and the default is up, down, up, down, up, down, then you can anticipate the next up and the next down. So it's not just that you enter correctly at the correct side of the range. You can anticipate that happening, and you can anticipate wicks happening. So let's just assume that this would bounce further up, right? What we could do is at this, because this could happen, right? So here's the bottom of the range. However, we went here. So everyone's like scared now. Okay, we're just going to dump now, right? What could happen though is that this is just a liquidity grab for further move up, right? Assuming that. So what would happen here is if we would long here, okay, at the bottom of the range, we would add in more orders lower here in case this liquidity grab happens, because when it does, then our average entry will get so much better. So when you get to the bottom of the range, the actual bottom of the range, you're already in the profits. And you compare this to someone that, enters, well within the move of the range. So they enter at like, the middle of the range. They don't have a lot of area to make profit in. However, you're already making profit when they're not even in the trade yet. So that's a huge, huge advantage that you have just by understanding the strategy and then anticipating the trade rather than chasing it. So that's the important part, and that's when I say we get good deals. That's what this means. It means that we're anticipating a trade, and into the trade, when we go into the trade, we have a much better setup, much better average entry than most people that trade the same exact trade. Because it's obvious that there's going to be shorts here, right? It's obvious that people short here, but it's a very big difference. Do you short here at the bottom of the range? Well, which if I was a market maker, the first thing that I do is I bounce back up and stop you out. Like, that's the easiest thing to do. If you enter a short here though, and someone bounces to the top of the range to stop you out, nothing happened to you. You took profits at the bottom, some profits at the bottom of the range. You're up, you're in the green right now. So market maker can bounce around in the range as long as they want to, right? You're not going to get stopped out. Worst thing that happens is that you enter more, right? So it's a completely different mindset and completely different way of looking at it, different perspective, right? But that is the difference between institutional traders and retail traders. Retail traders react, they're reactive, right? Institutional traders, they are anticipating before the move even happens. It's not hard to anticipate a move. You're in a range. Like, more often, if you just bet that the price is going to bounce on the range, more often than not, you're going to be right by default, right? So, and then you add in, all the other stuff, and you will have a very, very high success rate, which is very important for consistency. So, yeah, that's everything that I want to cover. If you guys have any questions, let me know. I might have covered a lot. So if there are questions, no problem at all. And this is something that we'll be covering in the future as well. If you guys don't have any questions, all good. Hans wants to say something. Let me put you up here.
Yo.
Hey, how's it going?
Going good, man. Feeling a little better, but still got a pretty bad cough.
Oh,
but
man.
Everything else is looking all right. But yeah, I just wanted to say, man, with the stocks, something that I've realized, this works for just anything across the board.
Yeah.
When it comes to the time frames, hold on, little guy. To simplify, like going through all the time frames, I found that going in between, I was talking to Mumford about this. I think that's how you say his name. About the 5x5x5 rule. So it's easier when it comes to like not explaining ticks to him. So in our scenario, we use time-based charts. So what I figured is I like the 5 minute for the low time frame, 30 minute, because 5 times 5 is 30, and then 30 times 5 is, I think, like 2.5 or something. So I just used the 2 hour or 2 to 4 hours. So it's like you got those 3 time frames that you can look at the stochastics instead of looking through all the time frames. And some people, like if you're a beginner or something, you might get confused with all the time frames.
Yeah.
So I'm just saying like a simple way to get a good overall idea without going through all the time frames is to break it down as a 5 by 5 by 5
Yeah,
rule.
that's a very good point. That's a very good point because the strategy, it has a learning curve. It doesn't have a learning curve because it's complicated, but you need to train your brain to be able to connect the dots between the time frames, right? So going across 12 time frames might be hard at the beginning. So yeah, pretty much the best, like pretty good would be looking at the 5:30 and 1 hour. I wouldn't actually look at the two. Actually, if it works for you, good. You know, if it works, then well. The 2 hour, you need to make sure the 2 hour usually generally is like you can have, if there's one time frame misaligned, it's the 2 hour.
Oh, is it? Okay.
Yeah, but that can give you a lot of information as well, and that's why I like using it too. But you know, if you're using 3 time frames and you know one's misaligned, so just keep that in mind. However, if that works, perfect. And that's also, by the way, why we you know started doing all the indicators, and that's what exactly actually what Porcupine is doing. It's taking all the lower time frames and putting them into one indicator and one score, so it's easier for you to look at all the other time frames. For example, here, right, right here, the 5 minute has been topped out the entire time, not working, right? The 15 minute has been topped out all the time, not working. However, when you look at the score, you see that the score has been increasing all the time. So whereas the other time, the stochastics, they have just been topped out, right? Because they're nowhere else to go. However, when you take the overall score of those time frames, it was still increasing, and then it started decreasing. And when it started decreasing, what did the price do? Started decreasing, right? So that's why we even started with the indicators, because the score overall, or like the indicator, takes care of the hard work, or at least part of it, so you don't have to, you know, memorize all the lines by yourself, but rather just have one indicator with one score that takes all the lines into account. It's not the only thing that you should be looking at, right? But you could say that you look at 3 time frames, right? Also the higher time frames, and then you look at the indicator, because that in itself has like 4 or 5 time frames in it. So that might be actually a good point as well. But really good, like if you're just starting out, it's a great idea to start with a limited number of time frames, and then as it gets easy for you, then you can slowly start adding in more time frames till eventually go, you know, across the board and you do all of them. If you do all of them, you have all the granular small data, and then you know when you have situations where you can be like, okay, the price is going to go, we're at the bottom of the range, the price is going to bounce up to the top of the range, and then we're going to have a big move down. Like that is something because you've aligned all the time frames together. But you know, starting with 2-3 time frames, maybe the indicator, if you have access to it, together will give you a pretty good idea. And then, you know, as you've done 10, 20, 30, 40 trades, whatever, just as it gets easier for you to digest, you can just keep adding in more time frames and you will see how much it will help you.
Word up. Okay. I feel you on that for sure, bro. And then that 5 by 5 by 5 rule also works for a price action. Like that's what I use. I use the 5 minute for entry, 30 minute for the mid, to find my minimize my levels and zones. Like for example, like 2 to 4 hour, I'm using for my essentially, and my shift and structure can happen in 30, and then my entries happen in 5. So In the 2 to 4 hour, I can have like a big zone, like for example, like a big inefficiency. I use a 30 to minimize that and kind of like, you know, specify it, and then the 5 I'll use to enter. So
Exactly, and that's something actually good that you mentioned it. The stochastics are just one way of looking at it, right? But the main part, or like the big edge, is looking at different time frames, because those are different perspectives and different interpretations of the same price. So essentially, you have a bunch of different viewers looking at the same thing, and when you listen to all of them, they will, you will get a much more exact answer, right? So looking at stochastics is just one thing. However, you can really look at any indicator. You can look at the moving average, or like in the simple MA cross strategy, but you look at 8 time frames, and you connected the dots together, you will have a really good idea of what's going on in the market. And that's just indicators, but price action itself as well. Simple price action, right? Like you just have some touches on supports and resistances. If the resistance is on a 3-minute, 5-minute, 15, 30, 1, 2, 3, 4, and on the daily as well, then obviously it's a very strong resistance, and it would mean something completely else than if it was just the resistance or support level on a 1-minute, right? So looking at different time frames will give you many more perspectives, and having alignments there is what will really give you the confirmation of what the market's going to do. So yeah,
word up, bro. But yeah, I just wanted to share that. Might be a good note for a lot of people.
Very good point.
But yeah, thanks for the lesson, bro. Appreciate it.
Very good point. Thank you for jumping in and adding in a value as well. It's always at the end of the call, you're like, hey, this is what will help you. And it's always great. I never think about it. So thank you for jumping in. If you guys have any other questions, let me know. And you can just write in the Discord or DM me, whatever. And yeah, if you're watching this on YouTube, make sure you check out the Discord. We're doing a lot of stuff there, a lot of these calls. And yeah, that's it. And I'll see you guys in the Discord.